Hello, everyone, and welcome back to the Velocity channel, where this is your bridge to financial freedom. Today, I want to go ahead and break down a question that I got, and I want to break it down real slowly, real methodically. I want to reduce it to the ridiculous so that you can know beyond a shadow of a doubt how to implement the velocity banking method in any area in your existence. I'm talking about car loans. I'm talking about mortgages, which we're going to get into now. I'm talking about student loans, any loans, folks. It doesn't matter, even lines. We can get you paid down very fast. Now, that mortgage that used to be 30 years, it's no longer 30 years. Ask our clients, okay? 5 to 10 years. They're getting rid of 200, 300, 400, $500,000 mortgages simply because they are moving their money the right way. We want to get into how you don't have to pay your credit card when you do this method of velocity banking. We're going to get into it, folks. It's so exciting. All right, before we do that, I want you to do something. I want you to like, I want you to share, and I want you to subscribe. You know why? Because everyone around the world needs to be set free. Come on. And they can be set free through velocity, namely velocity banking. So the question goes, CJ, I don't understand why you are using the line of credit to pay off loans, because don't you still have a line of credit bill? Don't you still have a credit card bill at the end of the day? So now, not only do you have a loan that you got to pay off, now you got a credit card that you have to pay off. And so what we want to do is we want to get into part one of this and just drill down on it, because we're going to show you how you don't have to pay your credit card if you do velocity banking like this. Check this out. All right, let's go over our scenario right now. A lot of times you were taught to segregate your income, and that's why we have the pie here. We have 1, 2, 3, 4, some people have 10, 12, 15 slices of the pie when you're not supposed to be segregating your income like this. Not at all, okay? It's all about consolidating your lines when you're talking about velocity banking. And so that's what we're doing. Okay, line of credit limit is going to be $15,000, let's say. Go ahead and put your numbers in. We'll walk you through it. The balance is $12,000. The interest rate on that is 20%. And let's just say that the minimum monthly payment is $600 each month. Now, do you know how long it's going to take you to pay off $12,000 if you are segregating your income, right, and paying just the $600 each month? How long is it going to take you? About 4 years. Okay, about 4 years. And that actually depends on your credit card company, because some charge you more. Okay, I know it says 20%, but each credit card is different. Okay, 4 years to pay off $12,000. And oh, by the way, you still got a mortgage. Now, instead of all that trash, why not do this? Okay, why not take the $12,000 balance, right? And you have the $12,000. And the reason why we have a balance there is because we're velocity bankers. We're not suckers, right? So we're going to go ahead and knock the principal, which, yes, you can call them. You can let them know, listen, I want to pay the principal of this loan. Yes, you can. Let them know, I want to pay the principal of this loan. And that is going to get knocked down to, let's do the math, $188,000 plus $12,000 is $200,000, okay? But we've knocked this principal down. We've chunked that principal. Why? Because the smaller the principal, the smaller the interest we pay. But the bigger the principal, the bigger the interest we pay. Now, the question is, CJ, now you have to pay your line of credit. Do I? Now listen, you get paid every month. Is that right? Okay, as you are paying your mortgage each month, right? Don't worry about this chunking principal. You're going to take the $12,000 from the line of credit. You're going to chunk that down. You're still going to be paying the $1,200 each month, right? And then what? That's right. Then you're going to go ahead and go over here and you're going to say, man, you know, I was a sucker and I used my checking account all the time. But this time I think what I'm going to do, instead of using my checking account, I'm going to use my line of credit as my new checking account. So the check comes in to your checking account. Then what you're going to do is you're going to transfer from your checking account. Let's just say you get paid $5,000 each month, $5,000 into your line of credit, right? And of course you got expenses, right? You got that $1,200 a month minimum monthly payment and other expenses as well. Let's say that comes to $3,000, right? So $5,000 in and then $3,000 out. Well, what's left in the credit card? $2,000. And so how long is it going to take you to pay off this $12,000 balance? Okay, let's go ahead and make sure we're on the same page. Remember what this formula is? This is the balance divided by the cash flow is going to equal your velocity term. And in this scenario, how long is it going to take us to pay off $12,000? It's going to take us approximately 6 months, not 4 years. Oh, and by the way, you no longer have to worry about this $600 a month. That $600 a month goes into your cash flow. You can do this with your loans. You can do this with your personal loans. You can do this with your truck loan, your car loan, your student loan, any loan, your mama loan, right? Your mother-in-law loan, your daddy loan. It doesn't matter what loan it is, okay? You can do this. Now, you're saying, but I still got to pay that. Where is your pay at? Listen, I just gave you $600 each month back in cash flow. You're using your line of credit as your checking account. So where did you pay? The measly interest, okay, off the 20%. Where did you pay is what I'm asking. Because you're thinking that you have to pay the $600 each month, right? No, you already paid $5,000. Are they going to ask for more money than $5,000 each month? You just paid them that month. And then $3,000 out. And then you're going to pay him again next month. $5,000 in, $3,000 out. Until you pay them all off in 6 months. And oh, by the way, when it gets filled back up, you're going to hammer this away, right? And what is that going to look like? Let's go ahead and do the math. Now you're at $176K. But 6 months went by. So you're making what? 6 months worth of $1,200 payments. You can do it. That's part of the $3,000 expense. All right. What is that? 6 months? What is that? 7,200. So we're gonna knock another 7 off of that. Okay. Right. Look at how fast it's going down. That's 169,000. So you're gonna get rid of that house in what? 6, 7 years? Let's just say 10 years. Okay. All by reallocating your finances. And you could do it even faster. You get a faster cash flow, right? You get more cash flow by either increasing your income or decreasing on your expenses or both, right? So where's your payment? You're using the line as your new checking account. Where's your payment? Okay, remember, I give you back $600 each month in cash flow. That's yours. That's yours. All right? And so I want you to really look at this. I want you to study this. I want you to rewind this video and realize that you have to start using these banking tools, okay, so that you can get more. And oh, by the way, as you're continuing to pay like you're doing, I'm talking about $5,000 each month. They consider it a payment. We consider it a transfer. Okay. And as you're continuing to do that, what will they do to this limit? They'll do like that. And then all of a sudden, you'll be at 25K, right? 30K, 35K. Why? Because you're thinking like a business owner. Because you're thinking like a banker. Okay? And that's where it's at. In this economy, this debt-based economy, This is the way we must think. And if you're tired of trying to do all that by hand, we have an automated velocity banking system that you need to get your hands on, okay? If you have any questions, just let me know. God bless you, and you take care.